Well, it certainly doesn't get much better than that in the week in the market. Green all the way week long. What a wonderful week it was, and two historical moments that you got to be a part of. Let's talk about it on Friday after the bell. Greetings, brothers and sisters. What an outstanding week that was. Green days all over, and the biggest, quickest market rally in history. So you got to be part of history this week, and I did too. And another great part of history this week that's going away is the pattern day trader. And the pattern day trading rule is just something where if you make more than four trades in a week's time, they flag your account and penalize you and all these other kinds and put restrictions on you and all this other nonsense. It's an antiquated rule and there's no sense that it's still around and it's going away. Now that doesn't mean it's gone away. It's going away. They still have all, the paperwork and all the filings and all the nonsense, but it'll be gone probably sometime about summer. So no longer do you have to worry about trading overnight in one day's time and canceling out your trade. And why that's fantastic is because let's say you put on a trade and in less than 24 hours that trade has absolutely went in your direction, screaming in a good way, and now you want to take it off to take your profits. Well, if you're concerned about being a pattern day trader, you can't take it off, or otherwise your account gets flagged and all these things happen. So it's nice that that goes away. Let's say you want to do zero DTEs. Well, that's going to be a problem if your account's under $25,000 because now you can't. If you close out an iron condor, that could be counted as two trades and you could not even realize it, do two iron condors, close them out, and boom, be a pattern day trader. So it's just about, it's an archaic kind of rule. We're glad it's going away and we could say goodbye quicker than this summer. So let's see what happens. Once it actually files with FINRA, 45 days later, the pattern day trading will go away. We'll see when the filings actually go in, and we'll of course keep us updated on all of that. But hey, what a great week. I hope your portfolio was just absolutely on fire this week in a positive way. The stock market was up so much. The numbers say the SPY was up 4.5. The triple Qs, which is more of a NASDAQ, was up 6%. IWM, once again, small cap stocks up 5%, a little bit over. So that is a great sign of good strength in the market. We had oil that was down 11%, but it showed a great stability. Even though it was down 11% again off, I think 14% last week, we're looking at a more stable environment for oil to hang out in until the conflict is completely resolved. So oil now is able to be approached. Maybe you're getting in there doing a little bit of a put credit spread. Maybe you're a little bit of a strangle person in there, but it's opening itself up to actually be playable instead of just taking a directional shot and hoping for the best. So looking also to the market all over the place, everything was good. Green in almost every area of the market. And it's about time. It needed a good bounce back. I don't care what anyone says. They needed that bounce back to get back to all-time highs. The SPY back to over 7,000 is exactly where we need that. And it is part of the bull market. It's America. It's capitalism. Businesses want to grow and become more profitable. So it's natural that the market just wants to go up and run up. Now, I understand that pullbacks and everything are necessary and healthy. And that's one of the things I want to talk about today, is that I don't want you to get out over your skis just because the market's had a really good week. Don't start going and rushing in there and putting out all these naked puts or all these naked calls that you're doing. And naked calls are very dangerous at any time of the market. So do be careful. Don't get too lopsided here. Keep your delta for the whole profile around that zero mark or at the 1% mark as best you can. And don't get too caught up in, hey, it's over and we're running, because there's a lot of geopolitical stuff that could still happen and a bunch of nonsense. You know how it is. People get neurotic, they get in the market, they start selling off stuff. Companies do crazy things. And one of the craziest things the companies did this week, and I don't know if you're familiar with, was Allbirds. Allbirds, the shoe company, decided that they were just going to get into the AI systems and they're going to be in the AI platforms and they're going to do away with making shoes. Well, what a shoe company knows about AI infrastructure is zero. But their stock went up 600%. Dang it. Dang it, we had that in the Fur Traders portfolio, but we didn't have it live. Oh man, if we'd had that on 600%, what a great week. But it's not going to stay there. There's no chance that's going to stay there, but it's almost impossible to short this thing. So, but it just shows you how neurotic the market is. A shoe company says they're going to get into AI infrastructure, and everybody's like, "Oh my gosh, I got the FOMO. I got to get in on that." Absolutely absurd. Also, you have. This is the one thing I want to say is gaps. When you have a market as lively as it is now, you find a lot of gaps. And what that is when you see a candlestick and then you see another candlestick and a big hole in between them. There's not connecting lines. There's not connecting candles that go into the pattern. So when you see a gap, it is almost assured that that stock's going to come back and close that gap. That's what they do. Now, is it 100%? Of course not. Nothing's 100%. I can't sit here and tell you anything's 100%, and I'm not trying to give you financial advice anyway, because I'm not a financial advisor, and that's not what we do on this channel. We just talk about strategies and different things and structures and different stocks that is going on just to have a good time. So, but when you look at something like HIMS that's had a back-to-back very good news to their stock and it's jumped up, well, it creates gaps. And there's a gap on HIMS down at about the $16 mark, where you're thinking, well, Jeff, it's almost up to $30 now. It's not going to dip back down to 16. Well, I bet people thought the same thing when it was trading for $60. Just understand there's no timeline on when gaps get filled, but gaps get filled. That's what gaps do. And also, though it may be running wild right now, the SPX also has a very nice gap laying in and around the small gap at 740, and then we have another gap at 6,600. So right around in there, you want to watch out after those, because if you get out over your skis and all of a sudden they decide they want to come back down and fill in those gaps that they created from these pop-ups, then you can get caught absolutely naked. And if you get caught naked, that's going to be a problem. But the put can be just as traumatic. If you get a put that's absolutely slammed down and now it's multiple hundreds of dollars under the strike price that you put out, you could be in trouble. So just be cautious about what you're going to do. Maybe, for a week or two, maybe put on those defined risk spreads instead of so many undefined risks. Just be careful is what I'm saying. That is the moral of the story. Also, we've been talking about space stocks. Once again, space stocks, a great week for space stocks. Fly up 22%, Rocket Labs up 30%. And of course, I'm not saying now's the time to get into them, and I'm not trying to create FOMO, but keep an eye on those. They are probably still going to do well into the summer. Yes, there's going to be a pullback, and hey, there could be a gap on one of those that might pull back too. So you might want to play that. You can even play both sides of the market on those. So just keep an eye out, because they're not a flash in the pan. But whenever you have an entire sector, like we've noticed many times with semiconductors, that just go up and up and up, and everybody's going up, sooner or later, kind of the cream of the crop kind of distances itself from the others. The others maybe start taking a little bit loss, like where the NVIDIAs and the AMDs start rising. Recently, AMD and all of the big semiconductors have been on a roll, but now we're starting to see names like, the TSM, Taiwan Semiconductors are starting to not keep up with your AMD, keep up with NVIDIA. I'm not saying they're not as good of a company, but they're just not running with them anymore. The smaller semiconductors, Navitas, was running with them for a while, but it's showing a little bit of sign of weakness. Now, when you see that and you're familiar with it, that's the time to strike. You've got decent volatility. It's down below 20% again, but it's down to 18, which is not bad. You can still get good premium for that. And right now is a good time to strike, especially when the market's going up and up. And then it's kind of, we're just going to hang out here for a minute. This week was a great time. I saw a lot of strangle opportunities and iron condor opportunities, and just opportunities abound, no matter how you like to trade. Perhaps, getting short stock was probably the great thing to do about 3 or 4 weeks ago. Well, maybe even at the beginning of the year. But now is not exactly the time to start buying into stocks. Well, sometimes you can buy high and then it'll go higher. But you want to look for a pullback. It's been running hard. It's going to pull back a little bit. Don't be surprised. You have that summer lull and that summer pullback. But, keep an eye out for your semiconductors. Tech is starting to rebound in a very, very good way. but not all tech. So keep an eye out on it. Your Mag 7s, some are starting to do well. Some are still dragging their feet. Microsoft had an incredible week this week. Apple, another great week. Amazon started to get some traction and started really at the end of the week to pick up some steam. So just keep an eye out. I didn't hear much out of Meta and, the others, but hey, just know that the opportunity's there. Just don't get in too deep. Don't get in too heavy thinking, hey, it's all sunshine and rainbows now. We can go ahead and do whatever they want. Know that you have to keep yourself in check. Keep that buying power in check, because right now your portfolio is at a high. So whenever the market starts to go down, your portfolio is going to start to go down with it, theoretically. But you have to have the cushion. So make sure and keep your buying power. Don't go hog wild. Don't go and spend all of your money right now because the market's up. Keep it all in check. But we had a great opportunity. We had a great week. It's nice to see all that green. I hope your portfolios did very, very, very well. And let's look forward to the next week. Next week should be very good. It could be a very choppy market. It could be a sideways market. But whenever you make higher highs like we have, the tendency in history is for it to go up and make more highs. Who knows if it will again? Sometimes it doesn't. But we'll be right there playing along. We play the hand we're dealt. We play the cards that we've got. And we just enjoy our time in the market. So be safe. Trade smart. Look for those gaps and start kind of keeping an eye out and see if you can notice, hey, my stock that I always watch, when it forms a gap, usually takes about a month to close it. Or I've noticed this may take a year to close it. But just keep an eye out. Something new for you maybe to look at while the market's up and you can actually breathe. So have a great week. We'll see you next week right here with me, Jeff, on Friday after the bell. And until that, have a great week. Cheers.